Hey market disruptors, the cryptocurrency markets are now officially in the longest bear market in the young crypto market's history. And while most investors have suffered enormous losses, a small percentage of very experienced investors are making moves today to make the profit of a lifetime. In this video, I'm gonna show you how they're setting it up so that you can take the same steps. So stay tuned. All right, welcome back. I'm going to talk about today the topics of volatility and the bear market. So we're in a bear market. That means the price is going down. Volatility being the price is going up and down. But seasoned investors use these opportunities to make maximum profits. They look for volatility, bear markets, and that's when most fortunes are made, not really in up markets. In up markets, everybody's doing it. The best investors, the most seasoned investors look for bear markets and volatility, and I'm going to explain exactly how they do that so you can do the same thing. Now, the first thing that we have to understand is that when we're talking about investing into cryptocurrency markets, Bitcoin and other decentralized cryptocurrencies, we're really talking about investing into a new technology. All right, so it's not the same as investing into other markets. So the first thing that we have to understand when investing into Bitcoin and other decentralized cryptocurrencies is that investing into cryptocurrencies is actually investing into new technologies. It's not the same. The principles, the rules of the game are different than if I was invested into equities and stocks and bonds and gold and all those things. It's different. So cryptocurrencies is a different game. It's a technology cycle. And understanding the four phases of a technology cycle is the key to getting wealthy while investing into them. Now, I'm not going to go deep into this because I've done a whole 4-part video series on this. Check the link down below for that wealth building series. It's super, super important that you understand that. So I definitely recommend you watch it if you haven't already. And I have a free guide that you can download because the video still can't cover a whole lot. So download the guide so you can understand that. But understanding technology cycles is the key to getting wealthy. But really, when you're investing in technology cycles, there's 3 things that you should be paying attention to. One is the price. The second is the innovation. And the third is the adoption. So let me break those down for you. So the price is how the value of that technology is measured, all right? So there's a difference between price and value. Value is how I value something, how much value I put into that. The price is just what it is. That's how we communicate the value. So that's the price, how that technology is valued. The second is the innovation. How is that technology being innovated? Is it rapidly growing? Are there new things coming out about it? Is it being developed? And then the third being the adoption. How many people are using it? And how soon until we see this new technology reach full-scale adoption? In the image here, you can see a couple of charts of how long it took for like AM radios or TV or internet to become adopted. So just the telephone took about 70 years to reach 80% adoption. The internet did about 15. So that's adoption. So price, innovation, and adoption. Those are 3 things we're going to want to look at. And understanding the relationship of those 3, price, and innovation plus adoption, understanding how those 3 work together is really the key for experienced investors to make massive profits, all right? So what they're looking for is differences in these relationships. They understand how the 3 come together, and then when they move out of balance, that's their signal to either buy or sell. And you can do the exact same thing, right? If you can understand these relationships, understand how they move, then you can make the same profits that they do. Now, volatility is typically associated with price swings. So when prices are going up and down, we'd say that's volatile. That's the volatility. And the faster it goes up and down, the more volatile it is. And so when it's moving rapidly, when price swings are really happening fast, we consider that volatile. The technical definition of volatility is a little bit different. So the technical definition is it's a statistical measure of the dispersion of returns for a given security or market index. So really it's about measuring risk. But that's a little bit technical. So for our purposes, we talk about volatility as just price swings up and down. However, my definition of volatility is a little bit different, and I think this is what most really seasoned and experienced investors use because this is the key. The way that I look at volatility is the difference between perception and reality. That's what volatility is for me. It's the difference of perception and reality. So smart investors, They look at it as that more broad term because that's the key to let them know what to do. If you can look at that term more broadly and understand its perception and reality, and what that means is, I'm sure you're aware about perception is how you understand something, the way that I look at something. So it may be this, but I perceive it as being something different. And then of course, reality is the truth. It's the actual existence of something. And so again, what I said is that volatility is the price difference between them. It's the difference of what the reality is and what I perceive the reality to be. So it's kind of a psychological difference there. That's what creates volatility, and I'm going to explain that. What happens on any new technology cycle is that the price starts really low. There's nobody there, there's really no market. In the beginning of a new technology, there's just a couple developers, there's a couple nerds in their garage tinkering on their computers trying to create this new technology. The people that are inventing this, they have a pretty good idea of the perception and the reality at that time, but the price is relatively low. And the chart on the screen kind of shows this. That first section is the stealth phase. All right, and in that stealth phase, the volatility is low, the price stays relatively low. But what happens is, as soon as the technology starts to develop a little bit quickly, it starts catching the eye of speculators. So next thing you know, some people outside of that initial group kind of take a look and they say like, ooh, this is like pretty cool technology, and they want to start putting some money into it, speculating, right? Gambling, betting on it. And then maybe they're investing into it. And what that does is that starts pushing the price up. And it's like a snowball. So as that price starts going up, more people start jumping in. As the price goes up, more and more people jump in. And as the price goes up even more speculators jump in. The price gets way ahead of the reality of the technology. So the technology was here, but as the speculators came in, it started pushing the price way up above the reality. That creates this massive bubble. And then what happens? You can ignore the reality, but you can't ignore or get away from the consequences of it. So what happens is all of a sudden everybody starts to realize like, hey, the price got way up here, the perception, but the reality is that the technology is still down here. Bitcoin isn't ready for prime time. In the dot-com boom of 2000, Pets.com wasn't ready for all those people to buy.
Tonight, we ring in a special Millennium series here on Moneyline, The New Economy. Is it a boom without end?
The perception got there, but the reality, it just wasn't there. And so what happens? The price crashes. Boom. What happens is the higher that it gets above, the higher that the perception gets above reality, when it corrects, it overcorrects. And then it drops off and it goes below. And that we get into what we call a consolidation period. It's not because the technology is worthless. That's not the point. It's not like, oh, this was like a tulip bubble and the tulips are worthless. That's not the case. It's just that perception got ahead of reality. And so then perception gets way below reality, all right? And then that's when the price is down. And then the market basically starts all over. So the price is low, reality continues to catch back up, or the perception continues to catch back up to reality. The prices continue to catch back up as well. And what happens is we have this, what we call a reversion to the mean. So the price, it got too high and it corrected, but it corrected too far. And then it comes back up, but then it goes too far and it gets too high. And it just keeps going, as you can see in this illustration here. And it basically just keeps going back and forth. It goes too high and it goes too low. The price is way too high, and then it overshoots the correction and now it's too low. And it just goes back and forth. And this is how market cycles continue on and on and on, just constantly trying to get back. And the further they get away from the mean, then the more they overcorrect to the opposite direction. So as an investor, this is where our opportunity is. This is where the seasoned investors move in to make huge returns. Sure, you can just make little returns, playing a little bit of the upside, but if you can really understand this piece, you can make a lot of money. So the opportunity that a seasoned investor looks for is to take advantage of the over adjustment. Either way, I'm looking for the over adjustment when the market has overreacted. I either want to sell when it's overbought, when way too many people buy and the price gets way ahead of reality. That's when I want to sell. And when it overcorrects and it drops and then perception is below reality, that's when I want to buy. And when you understand it from a really broad term, it's a little bit easier to understand. Hopefully this makes sense. Give me some thumbs up if you guys like this. And then of course, make sure to leave those comments and questions. You know, I love to engage in this and we'll get more into the discussion. But that's the key, is understanding when the markets are overbought and oversold. Now, I'm sure as you're listening to this and you're looking at this chart here, you're starting to think, or maybe you're starting to realize exactly where we are in the market cycle, right? So where are we? Where do you think we are in this market cycle? I think it's pretty obvious at the end of 2017, the perception was way ahead of reality. Yeah, the technology was evolving pretty quickly. With Bitcoin, for example, we had just got the SegWit upgrade, so we got a little bit of scaling that was put into place. The Lightning Network wasn't really there yet. We had all these other cryptocurrencies that were launching that were promising all these types of things. So the innovation was happening, but the perception was that we had this massive market when the reality is that none of that technology was really usable. However, today, the perception is all the way off of a cliff and it's overcorrected. And now Bitcoin is way more developed. Now we have Lightning Network. We have unlimited scaling today. We didn't have that before. With other cryptocurrencies like Dash, for example, they have, thousands of merchants that are accepting it, right? We're seeing adoption happening everywhere. However, the perception is still really low, and that's what creates the opportunity for us. The problem is it goes against our human nature. So our human nature, really, we're motivated by two things: moving away from pain and moving towards pleasure. And so as the price goes up, we want to rush in because that gives us pleasure, but that's really when we should be selling, when it's overbought. And when it drops the lowest, that's when it's the most painful, and we want to get away from pain, but that's when we should be buying. So you have to think about this logically, not emotionally. And that's how seasoned, experienced investors do it. And that's how you get wealthy. So hopefully that makes sense to you. Hopefully you can learn to spot these patterns, learn to understand the relationship of price, volatility, and innovation. Learn to understand these price swings and where we're at into overbought and oversold conditions. And I think you know where we're at right now. So fill your positions up right now. Hopefully that makes sense to you. Give me some thumbs up if you like this video. Leave some comments down below. And to your success, I'm out.